Welcome back, everybody, to the Informed Homebuyer Podcast. I'm your host, Rich Curtis, and as always, I have my co-host with me, Dave Miller. Hey, Dave, welcome.
Hey, Rich. Thanks for having me. Looking forward to it, or maybe not.
Yeah, we're continuing on our ongoing and never-ending series of rainbows and sunshine in the economic and housing news for you all. Today's subject is the likelihood of recession. So, is the fiscal policy that the Trump administration is currently going on with the trade wars and the tariffs on again, off again, and all the economic instability and uncertainty that's creating, is that pushing us further and closer to a recession? There are even some news outlets throwing around, as Dave referred to it, the D word before the podcast, depression. And how's that going to affect things? And if we do see a recession, we all remember, those of you who are old enough, like Dave and I have a little gray in your hair, you probably remember the Great Recession and the waves of foreclosures and the chaos and mayhem of all of that. And will this recession look like that recession? We're going to get to that at the end of the pod, so stick around for that. But Dave, let's start out with starting from back when, for people who didn't watch our last podcast, when Trump actually re-implemented the tariffs. What happened in the mortgage-backed securities and bond market, and then what has happened now with the continued sort of trade war and the stock market dropping like a hot rock at this point. So walk us through that whole progression.
Yeah, and so going back when the tariffs were first introduced, we saw a short term, and this goes back February 3rd, I want to say it was, where we saw the mortgage-backed security or the bond market really come down, which made interest rates go up maybe 0.25% just overnight. Okay, and then there was the talk of 3 or 4 days, or so we saw about a 5 to 6 day hovering after they took a steep decline. Then there was talks about suspending those or doing a temporary suspension on those for 30 days, and then the mortgage bond climbed its way back up, which meant interest rates came down a little bit. Then they reintroduced the tariffs and then some pauses. But simultaneous to this happen, and fast forward to this past week, is we've seen the stock market or the Dow really take upwards of a 10% hit. And so what we've historically seen and is when that happens, we see a flight to bonds. People get out of equities in the stock market and they go to the safe haven of bonds. And I've been doing this for 20 plus years, and that typically is always the case. Then we see a nice little improvement in mortgage interest rates because the bond market is stabilized. We did not see that this time. In fact, we saw a little bump, what's called 25 basis points, which is equivalent to maybe 1/8 of a point in interest rate for the better, because the bond market came up, but we've subsequently lost that gain. And part of losing that gain is, Rich, you and I were talking about is, there wasn't this massive flight to bonds, and simultaneously is all this tariff talk that's going on in terms of additional tariffs, additional countries, tariffs being imposed by, imports from additional countries. So a lot of moving parts here. And, for us to try to anticipate what's going on, it's not always as easy as what happened historically, or if this then that. There's more than the cause and effect has multiple moving parts.
Yeah, so to kind of recap that, Trump announced tariffs and the mortgage interest rates got worse temporarily. He paused tariffs and they kind of leveled out for a bit. Then he implemented the tariffs, and in a little bit of a surprise move that might not make sense to the average person on the street, they got better. And the reason they got better when he actually implemented the tariffs is because Wall Street freaked out. There was a massive sell-off. The Dow plunged. And as people sell off their stocks, they want to put their money in something that is traditionally considered safe and stable on the return front. And that was bonds. So they moved money to bonds. Now, after that, Trump paused some tariffs, added some new tariffs. He got on TV and someone asked him if he could rule out the likelihood of a recession this year. And he said, no. And then the stock market plunged again, but deeper, and people skipped right past the emotional safety of a flight to bonds and went to the emotional safety of a flight to cash. I was joking with Dave that I used to have a border collie, and the trainers warned me not to use an electric fence with my border collie because they run so fast they're beyond the fence by the time they feel the shock, and they're already out of the yard and gone. And that is essentially emotionally what investors just did with the stock market. After Trump said he can't rule out a recession, they went zooming right past the flight to bonds and started stuffing money in coffee cans and mattresses and keeping their powder dry to see what happens. So it is more right now, and correct me if I'm wrong, Dave, it is more right now the emotional uncertainty of all the on again, off again chaos that is causing this than it is the actual fiscal policy itself, because none of the fiscal policy has had any time to play out, and it's on again, off again. So this is actually just having the Trump administration's finger on the button and rattling everybody's nerves and going on again, off again that's causing this. We don't even have enough time yet to see how the fiscal policy would really shake out on the street.
Yeah, you're 100% right, Rich. And this morning we had the CPI number come out, which Consumer Price Index, which is what the Feds also use to measure inflationary rates. It was down a tick, but the word on the street is, okay, of course it's down a tick. There's all this stuff that's been going on for the last month. So is that an accurate barometer of the direction we're going? So, and then we're looking at jobs numbers. We're looking at all kinds of factors, but based on all this major swings, we're not seeing, huge unemployment rates. One of the talks are that, employers are trying to, batten down the hatches, and they're not firing, or they're not letting employees go, but they're also not hiring. So we're kind of in this stalemate, but the same, simultaneously inflation's maintaining, jobs are maintaining. So the Fed is in no position to use their tool of managing employment as well as inflation to lower the Fed fund rate to stimulate the economy. So we're like in this holding pattern. That's what everyone wants to have happen. And maybe I mentioned this before, is the Fed, everyone's looking to the Fed to do this, to improve our mortgage rates, to make borrowing money cheaper. We want that to happen. But overall, we're in a pretty stable situation as far as inflation goes and the Fed fund rate.
Yeah, and I think it's the strength of the economy leading into all this, how strong it was coming into this, that is kind of holding us through. And until he flips one switch or the other and leaves it on or off in a way people can reliably hang their hat on,
right,
this instability and stasis will continue. I think the challenge, the way I see it as a challenge with this sort of stasis that we're in, is that my opinion is, once he chooses one course of action, leaves it on or leaves it off, or if the rest of the world decides we're over it, we're just leaving ours on no matter what you do because we're done having our chains yanked, then the moves will be big at that point, because there's sort of all this pent up, the moves are held tight right now. And I think they're going to go one way or the other bigger once we have anything we can actually hang our hat on. So to some degree, the chaos is kind of holding us stable for a second.
Right. You're 100% right, Rich. And I don't expect to see a knee-jerk reaction. There's, the Feds have always been measured, and they want to see a historical data come out, and they want to see a pattern there, not a blip one way or the other. So it's not going to happen in a 30-day window or maybe a 60-day window. They want to see a trend that's continue in a certain direction before they start pulling levers. And I kind of use the analogy is like, we always want the Fed to come in and lower rates now. The Fed's, to lower rates or increase rates is a tool they use. And, I said, if you need to dig up a sprinkler in your yard and, you're going 6 inches to a foot down, you don't bring in a backhoe, right? And that's what we all want as consumers. We want the Fed, we want them to lower rates and benefit us, but we're not there yet. We're just digging little holes all over the yard. Let's get to a point where they need to use their tool, and they will appropriately.
And in that regard, up until the current chaos, the Fed, in a very measured way, backed us down from almost 11% inflation to almost their target of 2% without causing recession in the economy. So I think in a very nonpartisan way, they've done a really good job until now. And now they're in a tough spot, because just like us, they can't really make any predictions because it's on again, off again, on again, off. As soon as they finish their projection for the 25% tariffs, he's rolled them back again, and they have to crumple that paper up, throw it in garbage, and start another projection.
Right.
So, I mean, I'm sure Jerome Powell will look 15 years older, if that's even possible for him, next time we see him on the next Fed announcement coming up. But I think it's valuable to talk about the word recession is being thrown around a lot across the political spectrum. Economists are saying we are about 35% more likely to see a recession this year than we were 2 months ago before all this chaos started. The Wall Street Journal is throwing around the D word, depression, saying that the fiscal policy coming out of the Trump administration has the likelihood of throwing us into a Great Depression. That might be a little panic peddling for me. I'm not willing to hang my hat, like you called it, I love it, the D word, just yet. But I think it's interesting to note that whether it's MSNBC or the Wall Street Journal, which is by no means a bastion of liberal or progressive thought, both ends of the political spectrum are saying recession and maybe depression now. So these critiques are nonpartisan economic critiques of what's going on. That's the realm we're going to keep our critiques in. And so why are they saying that? Why do they think we're going to go in a recession? So we tried to explain this on our last pod, but if you didn't watch that one, a lot of uncertainty, or misinformation about what a tariff is. So no time ever in history has the exporting country paid a tariff anywhere in the world. That's not how tariffs work. So when they come on TV and say, we're going to make China pay, that's factually untrue. China will not pay $1 of these tariffs. Canada won't pay $1. Mexico won't pay $1. If Rich Curtis Steel is importing steel from China, when that steel gets to the port, Rich Curtis Steel pays the U.S. Port Authority the 25% tariff on that steel, and the U.S. Port Authority sends that to the U.S. government. This is essentially tax on the U.S. people without running a tax through Congress. We pay it. And that company has to decide, are they going to eat that 25%? Well, I think most of you know that's not how companies work. So they pass that on to the end consumer. So if the steel costs 25% more, that means your car could cost 25% more. And we just saw that with the big three automakers telling Trump, hey, the tariffs are going to make the cost of an average American automobile go up by $20,000. You can't do this. And he quickly rolled back the car version of that. But 70% of our lumber and gypsum come from Canada and Mexico. Framing lumber. 30% of our finished lumber comes from Canada. 100% of our wood shingles come from Europe. So all of these tariffs are going to hit the building and housing market, and that is going to cause inflation. That is going to cause prices to go up, and it could potentially cause job loss. And all of that is why we're building towards a recession in a lot of people's opinion right now.
Yeah, I think you're spot on, Rich. And I think the one thing that's missing here, and none of us really know, is what's really the end game and what's the timing of that with these tariffs, right? Tariffs don't always last forever. What really is the plan here? And are we trying to penalize? We're trying to, even the playing field, but it ends up costing all of us more here at home. Significantly more for goods and services.
Yeah, and you all out there, the internet there, you can disagree with me, but the goal often of tariffs, or the stated goal, is to bring manufacturing home to U.S. shores. NAFTA was put in. We lost a ton of factories in U.S. manufacturing to globalism. I agree. That bums me out. My family's worked in the trades all their lives. Dave's family's worked in the trades. He comes from a trades family. Nobody liked that. Nobody benefited from that. Unfortunately, that's not a genie you can put back in the bottle, right? They're looking to ramp up domestic lumber production 3 to 5 years to bring a sawmill online. And if over those 3 to 5 years, you keep smacking the international hornet's nest with tariffs and stirring all this up, the economy might just be so bad that by the time the sawmill is online, we don't have housing companies to build the houses, to hire the people to process the lumber, because we've gone too far with all of this. So none of these things have immediate solutions. So ramping up production and bringing jobs back to U.S. soil, well, you also have to shepherd the economy through so that it's strong enough by the time you can ramp up that we can still actually give those people jobs. So there's not a person on the political spectrum in America who would disagree that we would like a lot of jobs to come back to U.S. soil and see a lot of Americans gainfully employed and be buying goods with the Made in America tag on them. I think across the political spectrum, everybody loves that idea. I think there's a real lack of understanding of the reality of that, how long that takes, and what happens between now and then. And what the economists know and what they're trying to signal to us with this 35% more likely to have a recession is that doesn't happen overnight, and we're trashing things along the way in a way we might not be able to swing back from quick enough.
Right. And that brings up a really good point, Rich. And if, obviously a recession is, and historically we're going to go into recessions and come out of recession. It's how deep and how wide is that recession? And, that affects us, in our careers and what we do for a living. And that's what we're here talking about. So, maybe a good time to talk about if we do trend towards a recession or even end up in a recession, how does that affect the real estate market?
Yeah.
Why would this be different than the last recession? And I can certainly talk through that from a, the Great Recession was, partly, or greatly caused by irresponsible lending practices and, everyone under the sun being able to buy a home with no skin in the game, negative amortization loans, what we called stated loans, where you just said what you made, even though you didn't make it. And so people were buying homes way outside of their means. And so that pendulum swung very far to the right, and we came back very quickly with some government policies and restrictions around lending that, brought back what we should have always had is some responsible lending. And that's where we've been since, I would say, 2009, 2010. So we're talking 15 years of responsible lending. So folks that own homes today have been buying homes, bought homes in the last 15 years. They bought homes that they could afford and that they could make the payments on.
And with
And
down payment money. So they have
yes,
some of their own money on the line.
skin in the game. And so one of the things that we were talking about, Rich, which caused the chaos last time was, and so if you're thinking about buying a home and the R word scares you, or recession, in terms of, oh gosh, well, two things can happen. You could either wait, and you could wait to think, okay, well, home prices are going to come way down, because they did last time. There was a gluttony of foreclosures and short sales. We're not going to see that if we get into a recession. There will always be a slight uptick in foreclosures, in sort of short sales, but we're not going to see this giant swing and decrease in values. And that's because, the responsible lending, and people, when they were foreclosing before, oftentimes it was a choice. They were upside down 100,000, 200,000, and there was no real consequence for them to go to foreclosure. You and I talked about, they opened up a line of credit with, on top of their mortgage, and they bought trucks and, whatever, boats and whatever, remodeled their house, whatnot. And then walked away from all that, because then they didn't have to pay the bill. There was no bill that came. There were no taxes that came. There was no 1099 for that money that you had to pay taxes on.
And because they were allowed to buy with no money down, they didn't really lose anything on the house except any remodel or moving costs, where it was very minimal loss to them. So we saw a lot of what
Yeah.
were called strategic foreclosures at the time, where they can make
Yeah.
the payment, but they did the math and were like, well, my house isn't going to be back to what I owe on it for 10 years. I'm going to put the keys on the counter and walk away and restart my life. And no judgment. I'm not blaming anybody. It was a hard time and hard decisions had to be made, but the metrics aren't the same now. We are unlikely to see strategic foreclosures because people have both a lot of their money wrapped up in the homes now and a lot of equity that they frankly could cash out and use to fund their life while they wait to, get a new job again. So the homes are now of value or a resource to them in a bad economy versus an albatross around their neck like they were in the Great Recession.
Right. Well, simultaneous to that, Rich, when you talk about putting the keys on the counter and walking away, people are also faced with, and they were getting advice, and oftentimes maybe bad advice that, hey, you don't have to put the keys on the counter, just don't make your payment. And until they come and kick you out, and there was such a gluttony of these things that they couldn't keep up with it, people would live in their home with no mortgage payment for a year.
Or two. I had people make it two before they called me and said, "Oh, I really got a short sale now."
Right. And so like, maybe you put, at that time, maybe you put, 25,000 or $50,000 down, but you did the math and say, well, if I don't make a $2,000 payment for a year, I just saved $25,000. I'm stocking that cash away. I can go buy a rental or go get in a rental and give that landlord a full year's worth of rent when I'm ready up front. So,
and try to recover from this mess. Yeah.
Yes, exactly. So
because at the
this is
same time,
completely
those
different.
people, at the same time as people were watching their 401ks or their investment accounts plummet, their net worth just fell to near zero. And so any way they could claw back any cash or get some cash for the restart of their life from that recession, they were doing, and so
Right.
yeah, there was a lot of strategic moves for people to try to just salvage something out of that recession. So I think when we talk about the Great Recession, some of you watching may not, you may have been a kid when this happened. We're talking, I think officially they call it 2008 to 2014, kind of thing. I saw the real estate business really start recovering in 2008. I experienced the early effects of the Great Recession in 2006. I left for Europe on my honeymoon in the summer of 2005. And by the time I got back in the fall of 2005, everything in the real estate industry had already changed, on the ground. The waves of foreclosures hadn't happened. Goldman Sachs hadn't fallen. But before that, we had the insane multiple offers, write an offer right there in the kitchen and take a picture of your kid on the couch and beg people to take your offer, kind of insanity, very COVID-like market right before that. And that all changed for me by the fall of 2005 even, but it took another couple of years before it hit the big banking institutions and it all came, crashing down.
Yeah. So good thing you went and spent all your cash reserves on a European honeymoon. And then when you get back,
That's
yeah.
right. That's right. Live and learn. Like I said, a lot of gray hair. But so the reason this will be a different kind of recession, there's different things that fuel a recession. And what fueled that last recession very much was bad lending practices and waves of foreclosure, because people just didn't have any skin in the game. It didn't matter to let that asset go. It actually was a smart financial choice, in the long term for these people to do that. This recession, what they're predicting now, is going to be caused by, if it happens, inflation and job loss. And that's a very different kind of recession. And so those people, if they lose their job today, well, they have equity in the house. They maybe have a severance package. They're going to take a breath, figure out what to do. They maybe have a spouse who's still working that can cover the mortgage payment, or they maybe decide they are going to sell and move, but they have equity. So they're just going to sell and move and use some of that equity money to fund their life. They have a lot more options than people did in 2008. So what does that look like? What do I think is likely if we make a move to recession, which is not, it's not 100%. We are 35% more likely to move towards recession. We're doing a thought experiment here so that you can have a framework for how to think about this and make decisions for yourself. We're not saying we're 100% heading towards recession, but if we do head towards recession, what do I think will happen with real estate prices? In the near term, I actually think if he continues with all this tariff business, we are going to see prices increase. Now, that might sound a little weird when I'm talking about recession, but in the near term, and Dave, you can tell me if you think I'm wrong on this, but what I see happening is the increase in cost to lumber and goods driving up the price in the new housing market, which National Association of Home Builders already said it's going to.
Right. Yep.
And then that will put more pressure on the resale market. Now, if the interest rates don't come down considerably, the resale market won't loosen up. All the people experiencing the lock-in effect, meaning I don't want to sell my house because I have a 3.5% interest rate. If the rates tick down to 6, they're still not selling their house, right? We're not going to see a significant easing. I would say, Dave, we talk about this a lot, in the 5% before we see easing of that in the resale market. Would you agree?
Yeah, I would agree with you. I think that front number needs to be a 5, even if it's the high 5s. I think that's where we're going to see a lot more, reprieve. And, the other piece to this whole thing, which we haven't talked about, is the enormous amount of consumer debt. That's also, which separate, but that's also part of this, challenge of where in our industry before people were refinancing or, eliminating a lot of that consumer debt. They're no longer in a place where they can do that.
And that's piling up as the cost of goods and services pile up and get bigger.
That is
as well.
Correct. Yep.
Yeah. And so some people could be forced into bankruptcies or things where they won't have, and those don't flow through to your home, so you won't have to be forced into foreclosure.
Right.
But in the near term, if new construction goes up to the point where people say, hey, I can get more house for my money because new construction is building smaller houses because of the cost of goods, or I can get more house for my money because new construction is more expensive, and we put more pressure on a resale market that is not easing with more listings coming to the table because rates haven't come down, then that will push prices in the resale market up temporarily. And the easing there will come from enough job loss and enough pain in the economy for the Fed to crank that rate down. And we will start to see some forced sales by people moving for new jobs or needing to pull the equity out to cover their costs because of job loss and that sort of thing. And once the economy breaks enough, we will start to see prices start to fall. They won't be
Yeah.
falling in the waves and the big jumps like they were. We saw 40 to 60% loss in real estate value in the greater Sacramento area. We were one of the hardest places hit in the country during the Great Recession. I don't see this being anything like that. Or if it is, it will happen over a lot of years, not in such a compressed time. You know, if he were to just keep his foot on the tariff pedal for his entire 4 years, then we're going to see that wash out over the economy over the next decade, and maybe we'll see that kind of loss in the housing market. But in the near term, it's going to be slower and more measured than it was in 2008. So I think sitting on the fence for price reductions because of this recession is probably not a wise move when it comes to deciding to buy a house now or not. I think your metrics for deciding if you buy a house now or not is your confidence in the stability of your employment and your emergency fund savings and your ability to pay at the current rates without an expectation of rates coming down. Those are the 3 criteria I would be using to determine whether I buy a house right now, not recession or depressionary thoughts.
Right. And people need a place to live. And your alternative is to buy or to rent oftentimes. And not everyone's got an opportunity to live with mom and dad or Aunt Betty or whoever that is. So, I think sometimes you're in a position where, what are your alternatives? And sometimes buying is the best. And back to your point, Rich, with the price reduction, it really comes down to supply and demand. And, we've been looking, and the housing supply, I think we talked last week, was at a
like
2-month level.
Yeah.
And
less in like Sacramento, downtown, Midtown, Land Park, Curtis Park, like 1.87 months. Placerville, rural Placerville, 2 months, still massive pressure, massive seller's advantage in the market.
Yeah. So let me ask you this from your, experience, how many months of supply is it then when you start seeing price pressure pressure on pricing start to come down?
Oh yeah. Over 6 months, right? So like
Okay.
3 months and everybody 2 months or less, 3 months or less, whatever. In general, 3 months or less, you've got a pretty strong seller's market. 4 to 6 months, you've got a relatively neutral, stable market. Over
Right.
6 months, you start to see it shift to a seller's market. We were at times like 18 months or more.
Sorry, if you hear that in the background, apologize.
Yeah, that's Dave and I were both dealing with dueling dogs today in the studio. But if you remember back to the Great Recession, we had at times more than 18 months of inventory, which made it just this massive buyer's market, price reductions all over the place. It was actually, if you still had a job and had money, it was the best time in my lifetime to purchase a home. Just so many people couldn't, because of the situation there. But yeah, so anything above 6 months, we're going to start to see it shift to a seller's market, but it really gets ugly and you see big price drops in the 12 to 18 month range. So that, and I don't expect to see that this time out of what we're seeing now. Now it could get there if things get worse, and that's where all of this instability and uncertainty comes in. If the Trump administration keeps throwing tariff after tariff, we just saw another exchange where the leader up in Ontario decided to charge 3 U.S. states 25% more for their power, which was a very strategic retaliatory tariff that doesn't really cost Canada anything, actually generates money for Canada and costs Americans money. That was I'm not cheering for them. I'm just saying, if you were looking at the chessboard here, that was a tariff move that hurts us and doesn't hurt them, which is a powerful move in the trade war. If we start to see more things like that hurt us more quickly and allow the people we're in a trade war with to not feel those effects, then the pain in the economy will ramp up faster and we'll see these things come about faster. Now that's a lot of crystal ball work there. We're not saying that's going to happen, but if it continues, that's the type of thing. So overall, I see short-term increase in prices, long-term decrease in prices, but a more slow stepped and measured decrease in those prices over time.
Yeah, I completely agree with you, Rich. And I think the key here is not overreact one way or the other. We just got to kind of watch and see how things play out. And every buyer, as we always say, every potential buyer, seller, their situation is unique. Let's explore your situation. Let's identify what your timeline looks like. how long you plan on living in a home. If you're looking to buy your first home, or maybe your move up, it's your forever home. We know you're not going to sit and wait for if the R word comes or not. You need to buy, you're ready to buy, that may make sense for you. And we always talk about the ability, ideally down the road, if rates are higher now, is the possibility to refinance. It's never a guarantee, but if rates do come down and you have enough equity and you qualify for a mortgage at that point in time, there's always the possibility to refinance. Which brings up a kind of another point: is a lot of people have assets. They have, maybe they're heading towards retirement, and will have some retirement income, and you qualify now for a mortgage, but you may not qualify 6 months or a year down the road. And that doesn't mean you don't have the cash. You could have a significant amount of cash, but in the mortgage landscape, you could have enough money to pay your mortgage for 30 years. But if you're not showing income to qualify for the monthly payment, you can't get that mortgage. So those are all things we talk about. And sometimes it's best to, get that now while you qualify. And we've done that, Rich, a couple times. We've had folks come to us and say, hey, I'm retiring. I got 3 months left. Oh crap. Like we got to move quickly, because, you're not going to qualify once you leave your job, because however you're taking, you might be taking a lump sum payout versus a proven, pension, or you're going to go to Social Security, and I don't care how much cash you have, and you don't want to put it all down on your house. You want to save that cash and be able to make payments. So everyone's different. And so we'll talk through your situation and see if, no matter what's coming down the pike, if it makes sense for you or not.
Yeah, there's no blanket real estate advice that's good advice. So on the show, we try to give you a lot to think about, ways to frame thinking about these things, ways to frame your decision making. But if you're at a decision making point, if you're at that inflection point now, the best thing to do is reach out to your trusted professional and get good advice. If you're in our markets, Dave and I are in Northern California, El Dorado County, Sacramento County, Placer County, Amador County, Nevada County, that area. Reach out to us. If you're not, we can reach out to us and we can connect you with a trusted professional across the country. Or if you already have your own, reach out to them. But if you're at decision-making time, don't try to make these decisions in a vacuum. Get some professional advice, because even though maybe for one person, the right call is, keep your powder dry and wait and save your money and see what happens. Like Dave said, if you're that person who's retiring in 3 months, the right choice is get out there and lock up a home so you can lock down your housing costs for the rest of your life, and do it while you can still qualify for a loan. That's radically different advice that is essentially, regardless of the economic or market forces, you have some personal forces that would allow us to recommend something one way or another. So if you're at the inflection point right now, the decision-making time frame, go ahead and reach out to a trusted professional. Our contact information will be in the description down below, or reach out to the people you already work with. Get some good advice right now. For the rest of you, I think, we are going to continue to come back to you week after week, give you updates on this, what's going on. For now, mortgage rates are relatively stable. Prices on homes are relatively stable. The stock market's all over the place. There's a lot of uncertainty out there. If you need help with a decision right now, give us a call. If not, keep watching, keep learning. We really appreciate you taking the time for your financial education with us today. And we'll see you on the next one. My name is Rich Curtis. Thanks for coming.
And I'm Dave Miller. Thanks, Rich.
All right.